Okay, so since this pandemic hit, the general public kind of didn't got into got into a forbearance on their mortgage, right? Mm-hmm. Most of the people don't understand what that is.
Right.
I've talked probably 80 people out of forbearance because they don't really understand what it was. They just go to their website, Wells Fargo servicers. They go to the servicing website, pay their bill or check it out, and they say, "Hey, push here to call, to go into forbearance."
To make it so easy.
To make it too easy. Mm-hmm. There's no qualification for it. You press a button and you can skip your payments for 3 months. Well, why not? Great. Well, that's great. But some people are working and they skip their payment for 3 months, and guess what? In month 4, you got to make 4 payments all at once. Oh, well, no one told me that. Well, how do you think that was going to play out? Oh, they were just going to put it on the back. Well, did you have a conversation with somebody about that? Well, no. They just push a button. Push a button, get a mortgage, right? It's the same bullshit. Push a button, get forbearance. That's basically what they were doing. And so, but the problem is they don't really know what they can do. So think about it. There's, now there's almost 5 million people in forbearance, right? Mm-hmm. So the servicers are not set up to accommodate, that many people. So if these people don't make their payment, then there's a moratorium on foreclosures up until next year. I think it's April or something. So if these people can never get caught up, guess what's going to happen next year? They're going to start foreclosure proceedings on the people that have not caught up.
So we're just delaying the inevitable.
Right now, well, they're going to give them a chance to catch up, mm-hmm. But if they don't, then the other problem is all the appreciation these people have had on their homes.
They're going to lose it.
They're going to lose it. And lose it because they don't understand what they got themselves into. And, so if you live in your house 5 years, you've had a 27% increase in value, right? So for every $100,000 worth of home, $27,000 a year of appreciation. So think about that. You've been in your home 3 years. What is that? 27. It's almost $60,000 of appreciation on a $300,000 home, which is kind of the average here, right? Mm-hmm. That evaporates, goes away, and then because they foreclose and you can't make your payment, and you can't get a loan out.
Is that because of forbearance, or is that because they get foreclosed on? Like what triggers that loss of depreciation?
Well, because they can never get caught up. And they think that they're going to try to modify their loan and get the payments on the back. Mm-hmm. But based on the Dodd-Frank, what they put into play after the financial crisis was you have to qualify. But if you're not working, how do you qualify for a modification on your loan? Basically, it's a refinance. You can't. So now you're stuck and you don't have the money to make up the payments. So then, you're in this bad situation. And now your credit starts getting dinged because now you're late, so your credit score drops, and now you can't get a refinance, you can't get a loan, can't get anything, and so the inevitable is going to happen. You're going to lose your house, which is going to be unfortunate for the people because they don't really know.
They just pressed a button and they didn't know what they were doing.
They didn't know what they were doing. They didn't read the documents. They just, we're in a pandemic. Everyone's kind of freaking out and looking for ways to Band-Aid themselves for whatever reason that is. Sometimes people have the money to pay it. Out of the 80 plus people I talked out of forbearance, they all had the money to pay it. They just thought, why not take advantage of it? Mm-hmm. But when you sit down and think about it, of what that situation really means, then you kind of, when I had those conversations with people, then they're like, oh, I get it. Like maybe your credit card payment, was $30-40 a month. That's different, right? Put that in forbearance, but you're talking about your house. So what happened was the payments get deferred, but the taxes and insurance don't. So the servicer has to write checks to the investor for the mortgage payments. So they're having to write checks on behalf of the borrower when they're not making the payments. They still have to pay because it's a secured instrument. a mortgage-backed security, so they've got to make those payments on behalf of the borrowers. So the servicers
are still having to pay the interest in the.
Well, they're not paying it, but they owe the money to the servicer. So now the servicer, they don't have the money to pay $5 million worth of loans. So now they're hemorrhaging cash. So they had to get money. The big servicers almost went out of business 2 months ago because they were hemorrhaging so much cash because no one was making payments, and they have to write the checks on behalf of the borrower, hoping to get reimbursed. When they don't get reimbursed, they've got to get the money somehow, and the only way to get it is foreclose. So
get the money back out of the house.
Well, because now their asset is, now they have to go to, they're going to they have to take it out of the normal servicing portfolio and go to a collection service.
That makes me feel great because I applied for forbearance. I'm like, hey, let's just do it.
Right.
Like see what's up with that. But once we got the papers in the mail that we had to sign, I'm looking at it and there's so little information in there about what they were going to do. It's like, this could trigger these 3 different things, but we don't know what those 3 things are.
Right.
It could be that, we have to refinance your entire, or remodify your entire mortgage. It could mean that it's all due up front. I'm like, that's not happening.
Right.
So I freaked out a little bit because they already stopped our automatic payments and everything. And I was like, so I go online, I'm like, we're paying this. And then I call them, I'm like, make sure we cancel this. I want this canceled. And so they got it canceled. And I'm like, I feel much better. My auto pay is going back on and everything.
A lot of times the servicer wasn't allowing the person to make the payments,
Well, and it seems like the servicers kind of rushed all this out too, right? They're, that's why there's so little information.
Well, because the government basically said do it, so they had to, adhere to what the public was thinking they needed because they made it so easy, But it also, another part of that too is if you miss your payments, you have to catch it up, and you have to wait 3 months before you can even refinance under whatever that new payment plan is. So you're ineligible to refinance your property for 3 months after you've skipped at least 1 month of a payment in a forbearance. So that was a problem with a lot of people. I had people in my pipeline looking to refinance, and they were going into forbearance, and we're like, well, wait, you can't do that. Or people that were selling their home and buying another and going into forbearance on the home they're selling. You're like, wait
Especially if you want to go buy a house right, you can't do anything.
We just don't know how it'll affect their credit. There's a blank spot on there. How is the servicer going to report that? What are they going to say? Pandemic, a zero, like blank. How does that affect your credit score when there's no payment there? I don't think the credit bureaus have that built into their pro forma of how to generate credit scores, that there's blank payments there. What is that going to do to your credit score? I don't know yet. We don't know until it plays out.
Right. It's so wow, that's so interesting.
Yeah.
And we probably won't know for another. What do you think?
Some of the people that haven't made their payments in June are just showing up. Not even showing up yet, like May, because they're about 2 months behind in reporting. So in some cases, they may not show up for at least 60 days. So maybe August you'll see people that didn't make the payments in June. It'll finally show in the credit bureau. So we'll find out how is your score going to be affected? What's going to happen there?
I feel like that's going to blow up somehow, I politically. Something's going to happen where a lot of people are going to be really upset because they didn't understand what they were getting into. Right.
Yeah. And they're talking about it now. I mean, it's coming out now because, you got a lot of the news channels talking about just do it, just do it if and now they're kind of taking the steps back and make sure you understand what you got yourself into, because now the consumers actually have time to breathe and consume what they drastically went into. Now they're in a position where they're like reading the documents finally, or understanding it and looking into it and reading more about it and realizing, wait a minute, this isn't really the right situation for me, and I shouldn't have done it, or I gotta fix it, and because you're gonna take your money. A lot of people that weren't working that were getting $600 a week. I mean, that's I get it. Those people that weren't working, they it was a good relief for them. But the people that were or had savings, listen, don't not make your mortgage payment. If anything, especially if you're risking, and you've been in your house 5 years and you're risking 27% appreciation, you know.
I don't think anyone understands that.
Right, and that's the
Right.
biggest piece right there.
That's
is
huge.
People, and it's going to create a market, you know, around that. You know, like we had a financial crisis before. That was created due to financial crisis. This is a pandemic created based on forbearance. We're going to have a whole possible, you know, REO market created around the forbearance pandemic situation.
What do you think the time frame is when we start seeing the ripple effects of like
I would say
houses going on the
probably
market?
around this time next year.
Yeah.
About a year from now, we'll see. You know, because they're gonna have to file the foreclosures, and they're gonna have to, you know, go through the system. Because, you know, right now the courts are basically closed, so all these lawsuits and stuff will start being filed immediately, and they're gonna be a backlog. So there's gonna be time delay, and, you know, these people are gonna be in a situation where it's just gonna be a matter
They're just
of
trying
time.
to save their home and
Live in there
right.
till it gets foreclosed, because they can't get a loan, their credit's shot, they can't refinance, they can't pull any equity out. So it's just, you know, it's just a matter of time.
It's crazy.
You know, yeah.
So tell me tell me a little bit about your story. How long have you been in this? Why are you in it?
So I've been in the mortgage real estate world for a little over 21 years. I graduated from the University of Florida with a finance and real estate degree and a minor in economics. So I got out of, you know, as soon as I got out of college, I was able to get a real estate license and a mortgage license, and I've had them, you know, for basically that amount of time. So I've been in this world. I grew up in North Palm Beach Gardens, you know, and so I went to college, UF, and then kind of came home. And been kind of in that space. I've done mortgages for a few different companies and banks over the years. And, you know, right now I kind of, you know, we're in a place where we can, you know, we're a direct lender as well as a broker. So we can basically, any type of loan out there, we have access to private lending, you know, that non-QM market starting to come back, where we can do, like, you know, bank statement loans for self-employed people, debt service type loans. You know, so, you know, I'm married. I have 2 children, a son and a daughter. Currently, right now, they are 11 and 9. So, you know, just kind of been in this market, in this area for, you know, 21 years working. You know, before I, you know, was just kind of here.
You know the area really well.
Pretty well, yes.
Yeah, I've been here. I've only been in Jupiter for 2 years now. We bought our condo a couple of years ago.
Okay.
And
Where are you from?
I'm from Colorado.
Okay.
Like originally. So my wife's from Alaska. I'm from Colorado.
Oh, wow.
We met down here. Got married. We have 1 kid.
Okay.
And yeah, I just got my real estate license, so that's one reason I'm doing this, is I'm just like learning all of this stuff, and just some of the stuff you're saying, I'm like, I've never heard of that term. I don't even know. Like, what is a whatever blanket state mortgage loan, blah, blah. I don't know. So that's like why I'm here to learn, because as someone who, I've already got 1 or 2 buyers, you know, just sort of interested, wanting to know. So like me going into that, I'm like, okay, I want to know. I want to be able to talk from a place of knowledge and be able to know what I'm talking about. Obviously, I'm not a lender, so I'm not going to know everything, but to be able to guide them into the right direction.
Sure.
So I guess the most basic things. So I've got a buyer, first-time homeowner. What are sort of the top things that I need to communicate to him about the loan process and about him getting a loan?
So what I would do, given your situation, if you want to learn more, know more, you know, like I would say, connect with somebody like me. Don't necessarily you provide them with the information, but have them talk directly with me and let me share with you the information as we go along, because every buyer, every situation is different. It really is, you know, and we're, you know, we have guidelines and kind of, you know, a common structure in most cases, but there's always going to be different types of scenarios. It's crazy. Almost every deal's got its own characteristics and good and bad and things like that. So, So for a first-time home buyer, the first thing we like to do is start with them as early as possible in the process. Look at their credit, look at their savings, look at their job situation, understand what that is, what they've saved, understand kind of where we need to be financially for whatever home they desire. So maybe if it's not today, maybe it's 3 months, 6 months, a year. Maybe they need to build credit. Maybe they need to fix some bad credit from when they were younger or something like that. They missed payments. So we have ways of fixing credit, building credit, helping them with the credit side, as well as showing them how they need to save correctly to buy the home and what they need to do once they buy the home. So we not only help them before they buy and then during, but even after. We're going to be a partner with them long term. Hopefully through every transaction they go through. We have partnerships with people like CPAs, financial planners, and stuff that we rely on if they don't have them to help us help them put them in the right financial situation to buy, stay in their home, and also create wealth for them down the road. So we partner up with some people that kind of help these people, because they don't know, right? It's just like you just started. Right. You don't really know. A first-time home buyer definitely doesn't know. They're not even in our market, and it's hard to even understand what goes on even when you're in it.
So when we got our house, we were first-time home buyers. We got a condo. So much we didn't know. And I feel like I'm a person who does a lot of research and, I do the Google thing. And even then, going into it, I mean, when you go to the closing table, I mean, the stack is this thick of what you're signing, and I remember one part of the process was obviously we were looking to get an FHA loan to begin with, but I think we ended up going with a conventional, like a 5% down conventional or something like that. Could you sort of explain the difference between those two and the benefits or?
Yeah. So FHA loan, 3.5% down, the least amount down. Not necessarily. So FHA is 3.5% down. So their qualification parameters are a little bit easier than a conventional. Mm-hmm. So if you have a lower credit score, or a higher debt to income ratio, FHA is a better loan. Most recently, we have conventional loans that we can do with 3% down. So we kind of look at both with a first-time home buyer and figure out what is the best situation for them. In some cases, we can't get a conventional loan approved, so we go FHA. In some cases, it's vice versa. So we look at all those options, and that's what I'm saying. The sooner we start in that process, the more we'll be able to help that consumer get into the right loan for them, whether it's FHA or conventional. And FHA comes with some higher costs. It comes with an upfront FHA funding fee, and it's mortgage insurance. Right now it's mortgage insurance kind of for life of the loan, whereas conventional, 3% down. There's no upfront funding fee, and there is mortgage insurance, but it falls off at a certain point in time. Most people don't ever play out their mortgage to when that ever falls off. Most people, once they build up enough equity in 5 years, you figure you've got almost 30% equity in your home. You could refinance and be at a 20, an 80% loan to value and get rid of that PMI. Mm-hmm. Given if interest rates, stay low and they, and your interest rate was higher, even if it was the same, drop in the PMI because you've created so much equity in the home, will drop your payment because you're getting rid of that MI payment.
Could you explain a couple of things? I know these are super basic, and I think I have a general understanding of them, but just to help anyone who's never bought a house before, could you explain two things: debt to income ratio and PMI?
So the debt to income ratio is there's what they call a front end ratio and a back end ratio. Mm-hmm. The front end ratio is your gross income. Okay, if you're an employed person, W-2 employee, it's gross income. If you're self-employed, it's net income. Mm-hmm. Okay, so that the front end ratio is that income compared to the housing expense. So whatever that housing expense is compared to your income, that's basically what they call the front end ratio. The back end ratio is your income compared to the housing expense and all of your debts combined.
Like car debt, anything else?
Credit card debt, whatever that is. So there's different parameters for an FHA loan and a conventional loan. So FHA allows us in some cases on the back end ratio to go as high as maybe like a 57% back end ratio, whereas conventionally you're maxed out at just under 50. So it gives you a little bit more buying power. There are some more costs associated with it, so that's why we got to look at it and understand what that is. Right. Yeah. See which one is the best solution, and those are how the ratios work. And then your second question was PMI. So PMI is, you have to, the servicer has to get insurance. They insure the loan. Any amount of the loan over 80% loan to value requires private mortgage insurance to insure the loan in case of default. So that's what it is. It's in case of default, and that's what the mortgage insurance is.
So if you're not able to put 20% down,
right?
PMI.
So you need PMI. You need PMI to ensure that you're gonna, that loan's gonna basically be be paid, insured,
right,
in case someone stops making the payments.
Got it.
Does that
Got
make
it.
sense?
So right. So the person giving the company giving the loan is covered. Right. From the insurance company. That makes sense.
Yep. So they bridge that gap there.
Okay.
So because there are a mortgage, they're securitized in most cases, Fannie, Freddie, Ginnie Mae, up to those levels.
Can you explain the difference between Fannie Mae and Freddie? I don't even have to. Like I took the test, and I had to answer questions about this, but now I forgot them all.
So Fannie Mae and Freddie Mac are similar. They're mortgage-backed security investors. Fannie Mae is bigger than Freddie Mac. Most people kind of go that avenue, but they have guidelines with each. So depending on the consumer's situation, we run them both ways, and we figure out if it doesn't work one way, we kind of look at the other way because maybe someone has a lower credit score and higher assets. Sometimes Freddie Mac kind of looks at higher assets better, and Fannie Mae looks at things differently. So there are some differences between them based on the profile of the consumer, and so those are those two. And then there's Ginnie Mae, which is the government-backed investor for FHA, VA, USDA loans. Okay. So mainly they're FHA, for the first-time home buyers and stuff. So they are the investor for the FHA, VA, USDA, and they insure the loans themselves, right?
So you're servicing the loan, but they insure the loan.
Correct.
Okay.
Right. So a servicer would be someone that you would just write your mortgage payment to that covers, handles that. But then they're taking that money and giving it to the investor, which is Fannie, Freddie, or Ginnie Mae.
I realize how complicated. I think most people think when they approach someone who does mortgages, they're the one who gives out the loan, and you're dealing with that person for the next 30 years. But that's not the case, right?
Well, so we try to position ourselves in the consumer's eyes that we are their contact, right?
That you are that person.
We are that person.
Okay.
Even though their loan's going to be serviced by somebody else and maybe serviced by multiple people over the many years, right? So two things happen. We originate the loan. It gets insured by one of the aggregators, and then there's a servicer that picks up that loan. So there's a servicer that comes in and services the payments of the loan. Okay, so that consumer's making the payments to a servicer who may own the loan forever, or they may sell it, and there may be multiple types of servicers out there that do that. And then there's the ultimate investor that owns the loan. So
there's like 3 or 4 different tiers.
There's
or people involved.
Right. So once the loan is sold or closed, it gets sold to the investor, and then the servicing goes to a third-party servicer, and that consumer's interacting with that servicer for just the payments.
The servicer literally just manages the payment back and forth to the investor.
Back and forth to the investor. That's it.
Got it.
So we, no matter who the servicer is, we are always their contact for all of their lending needs. We can, in most cases, servicers will service a loan. They may not always be the best person to work with on getting a new loan with or refinancing. Some like for instance, some of the bigger ones like Quicken, they service a lot of loans and they originate a lot of loans because of the servicing.
Right, they're a marketing company, right?
Yeah.
Got it.
Yeah.
I know the people we got our mortgage through. A couple months later, got a piece of mail that said, "Oh, your loan has been moved or serviced by this person," and we don't really hear back from them ever again.
Right.
And yeah, no, that's. I kind of wanted to get that clear in my mind because I know there was many people involved, but it sounds like different people who sell the loans. Everyone manages things a little bit differently in how they approach their business.
Sure.
And it would be to your benefit to stay in contact with those people because they're gonna upgrade to their next home. They're gonna get another home, right?
Right. I mean, so we do annual reviews every year with our clients to kind of look at their situation and figure out, what's changing in their life. Maybe like you're saying, they've had a child or and then maybe they have another one the following year. So they're in a place now where they need something bigger. So yes, in a couple of years from their first home, maybe in 2 or 3 years later, they're already thinking of moving and upgrading. And then we analyze that and say, okay, is it something you want to keep that house that you originally bought, turn into an investment, or you want to sell it and buy what you want? So we help them evaluate those things as they move through the process. So we always want to be a partner with them, hopefully throughout their whole life, and and not just for the real estate mortgage part of it, but helping them by partnering them up with the right people to help them, grow wealth in their life and make sure that they're, what they're doing is the right situation for them at all times. So we try to stay in contact with them. We talk to them, at least quarterly, if not more. We communicate with them a lot of different things. We help them kind of understand kind of all the stuff that's going on in their house. We try to let them know when it's time to do things. Like how many times you're in a condo, but in the home, I even sometimes forget, golly, you got to change your air filters, or you got to service your AC unit, clean it out. A lot of people, the AC unit backs up and they got guck in there and it floods their ceiling or something, and they don't realize when to do that and stuff. So we're trying to help them be proactive and with the maintenance on their home, and communicate with them some tips throughout the year, and try to be a partner with them.
That's great. I had a question about interest rates and loans. So is it true, so one of the buyers I'm looking for, he's a go-getter. He's got everything I don't know, color coded in his folder about all his paychecks and everything. He's ready to go.
Fantastic.
And so he's even way ahead of me. He's just he's already talked to 3 different lenders and blah blah blah. So, and he has found a lender that will give him an interest rate that he likes. What is there just sort of a standard interest rate that no matter what lender you go to, that's probably what you're going to get based on your profile? Or is there actually a big difference between different companies that you work with?
Well, yes, there's a difference, but you got to keep in mind, interest rates change daily, if not many times throughout the day. So an interest rate today could be totally different tomorrow, based on what's going on in the economy, or because think about it like this: the interest rates are driven by mortgage-backed securities. Okay, and mortgage-backed securities is kind of think of it as a stock or a bond, right? So it moves based on buy and sell. So right now, interest rates are very low because the government, the Fed, is buying so much mortgage-backed securities to keep interest rates low. They're the biggest buyer of these. They're issuing them and they're buying them, right? So they're keeping interest rates low. Now, the factors that come into play with interest rates are many things that come into factors. They're what they call loan level price adjustments on every single loan. So based on your loan to value, your credit score, debt to income ratios, all that stuff kind of comes into play to figure out what is your interest rate. And because it changes every day and sometimes many times throughout the day, an interest rate, I quoted somebody yesterday, could be totally different today. I was talking with a past client of mine, and we had talked on Friday, and I gave her an interest rate with some certain terms associated with it. And yesterday, they were completely different. They were much lower cost for her where they were Friday because interest rates kind of came down a little bit this week. So, and trying to communicate that to her for someone I didn't understand, and she was happy for it, but really didn't understand why. And in some cases it goes the other way. I tell somebody, hey, I can give you this rate today, or last Friday, and today I call them and say, hey, that same rate I was giving you is actually costing like a point today, or it's a quarter point higher. They're like, they're confused. And I'm like, well, that's just because the movements of the market. And a lot of it's driven by, economic factors, reports that come out. Like yesterday, we have housing reports that came out. Most of it's driven by unemployment numbers, or they have been in the past driven by unemployment numbers. Right now, we're in a crazy environment, which has created a whole lot of unemployment numbers, and it hasn't really triggered interest rates like it normally would.
Because the government's putting like a stopgap and help. Yeah.
Well, yeah, they're funding. They're buying so many of them. They're trying to keep interest rates low. Our prediction is that interest rates will probably be lower next year than they are right now. Would that come true? I don't know. That would be really interesting to see. But when we're talking to people today and they're like, oh, I'm going to wait for interest rates to go down. I'm going to wait for housing prices to go down, thinking that's going to happen.
You can't have both, probably.
Well, I mean,
you might be able to.
Right. I mean, currently today we're in a great market. Some markets are suffering pretty bad because of where they are, located. Like big cities and condo-driven cities, like the tri-state area up north. A lot of people want to get out of there, right? Because they've been stuck for many months. They're coming down here. They want space. They want a house. They want to breathe. So our markets in South Florida and Florida in general are just booming, but in some other places they're going. It's opposite. So it's going to be a.
So at what point for a buyer, if interest rates are changing all the time, does like a pre-approval letter, does that lock them in at a rate, or at what point can they know what their rate's going to be?
So the way we structure it is, we can give you a pre-approval letter. We can give you a payment. Really, what it is we actually have an app that we work with our real estate partners and borrowers on. So when we approve that person, it's a combination of things. It's not always the purchase price, because everyone was like, well, how much do I get approved for? It really is the payment associated with that purchase price that drives that complete situation, because that's how the income ratios are derived. So there's a front end ratio and a back end ratio that you have to be in line with. So it's a combination of maybe somebody has one property without an HOA fee, and they can get a higher purchase price, but when they throw in the HOA fee, it lowers their purchase price down because their buying power changes. So we have an app. We load all this stuff in there with a maximum payment. And so you, on the fly as an agent, you're working with somebody and, talking with them. It's Saturday and you're looking at 3 or 4 different houses and you're plugging in, because you know what the taxes are. We're kind of estimating what the insurance is. And if there's an HOA fee or not. You plug that information in and it basically gives you a green light if it works. So literally as an agent and your borrower simultaneously together can figure out does this payment work for this borrower, and they push a button and they get a pre-approval letter sent to them instantly from us. So no matter 24 hours a day, it's available. So we have customers that log into the app and run numbers on themselves at all times of the day.
Right.
And it's pretty cool because.
I mean, do most buyers care about the interest rate? I mean, I say that.
Yeah. Well, I mean. Everyone wants a lower payment.
That they do, right? But as a first-time home buyer, I'm just like, just get me in the house.
Right, 100%. So, yes, our goal is to take all those factors into play, give them the best terms we can get them, to get them into the house, to get them the most buying power that they can get. So, we always kind of try to give our clients the best rates we can, or the best loan product. Sometimes interest rates, change based on the loan product, but maybe they don't qualify for a normal conventional loan and they've got to go to a bank statement loan because they're self-employed and maybe they don't claim all that income.
Explain a bank statement loan. I haven't heard of that before.
So a self-employed borrower, we have so many of them here in South Florida, so many small businesses and stuff. So for a borrower that, say, say they have a company. Well, most accountants and CPAs, their goal is to minimize your taxes, right, that you pay the government. And if you're a self-employed borrower, you get a lot of breaks, a lot of opportunity to do that. The problem is as a self-employed borrower, as I mentioned before, for your debt to income ratios to work, we go off of the net number. So if your gross income, say it's $1 million, and you write off $900,000 of expenses and this and that, you only made 100, and that's the number we use to qualify you. So guys have a business. My business makes $1 million. I can buy $1 million home, but you only show $100,000. You don't qualify. So, but if that same business is in play and he's getting, he has, what is that, $80,000 a month or so of income coming into his business account, income, right? We can use that number to qualify him for that house. And I've helped people buy a couple $1 million homes that have great businesses, a lot of business income coming in, but they don't show it all on their personal tax returns. So it's designed for the self-employed borrower that has a good business, but takes advantage of the the write-offs that they can get.
That makes sense. As someone who owns my own business, I'm always looking for creative ways to.
So it's funny. I do this. I do this all the time with other self-employed borrowers. Is I have a system. We do a mortgage comparison on every loan that we do. So we compare for that client. Like we were talking earlier, conventional and FHA.
You can plug all the numbers in.
You can plug it in, and it tells them.
And then you see the difference. Right?
It tells them, okay, what are the payments? What's the best loan for you over a period of time? 5 years, 10 years, 15 years. What loan is going to perform the best for you based on the characteristics of that loan, the characteristics of that particular loan? And so what we look at too is, as I say, so a lot of people say, well, I'm self-employed. So this guy making, say, $1 million in his business, I'll just pay myself more. To qualify for the house. He's going to pay himself $250,000 instead of $100,000, right? Well, guess what? You've just created a tax liability for yourself for that other, $150,000. So, right? So
because the IRS looks at it and they're like, what's up with
this?
No,
you're claiming. So on $100,000, let's just say you're in tax bracket. Let's just say 30%. So it costs you $30,000, right? For every $100,000 you claim. Okay, so if you decide I'm going to claim, $250,000 this year to qualify for that house, well, now you just created another, $45,000 of tax liability for yourself, right? So what we do is we say, okay, that's what it's going to cost you to claim that money. But if you do a business bank statement loan, right? So the current interest rates, let's say it's 3%, and the business bank statement loan, say it's 4.5% or 5%. Let's just say 5. So it's a 2-point variation between the two loans. And you kind of do the math on it, so it's going to cost you, let's say, $10,000 more a year in interest, okay, between those two loans, which is fine. Or you're going to pay $45,000 in taxes, so you got to have that average for 2 years. So 45 times 2, what is that? So that's $90,000 in 2 years that you'd have to claim, because we average it out for a self-employed person, to as opposed to it costing you $10,000 more per year. So it would take you that much longer to, 9 years of that tax, but you're also getting write-offs. But let's just keep it simple. So it would take you 9 years to kind of break even. But wouldn't you rather, and you get that deduction, would you rather keep your money working for you and not give it to the IRS? Or just pay. And
at least it's going into your home
right,
or whatever,
and
your
just
property,
pay $10,000 more in interest. Over the year, it just always makes more sense for the self-employed borrower if they're writing stuff off today and not changing their situation.
That's good for me to know in the future. When we bought our home, I was self-employed, but I also had a couple of W-2 things going on. And I remember my wife was working too, and the mortgager was just like, look, we're not even going to touch your business. We're just going to go off of your wife and off of these other W-2s. And they got it through and they got it done just fine.
We did that too, depending on the situation for that person. So that's the thing. We just evaluate it all and look at it and see.
Could you explain the difference between, because I've heard this going around, the difference between a pre-qualification and a pre-approval? and the significance of that?
Well,
or if there's difference?
Right. So a pre-qualification is just a conversation we have on with a borrower. We don't ever really do pre-qualifications because it's not really anything. It's more or less somebody just kind of running numbers for you. Pre-approval
based on your word of mouth of what you say.
Right. And the pre-qualification isn't really anything that you would as an agent give to somebody to write a contract with. Pre-approval is we've ran your credit, we've looked at your income, we've analyzed your debt to income situations. We found a particular loan for you, right? So we sometimes even take it a step further. We do a pre-approval, but we also send the file to underwriting without a property and get them a loan commitment. So, which actually in some cases it's better in a market where it's really competitive, because if we can clear a borrower all of their personal stuff cleared, credit, income, assets in advance of them going into contract on a home, then when they go into contract on that home, we only need like 3 things: an inspection, an appraisal, and title work to be completed. And all of their personal stuff is done and approved. So, you're not 3 weeks into the deal, and the underwriter doesn't like something about the file, and they've already spent money on appraisal, they've already spent inspection money, and the deal starts falling apart 3 weeks, 4 weeks into the deal.
So basically it's already been underwritten before those things happen.
Right, before they go into contract.
Contingent on those other
3 things. Yeah. And that gives the borrower an opportunity to kind of shop as if they were a cash buyer, right? Outside of the appraisal, that would be the only difference than if you were a cash buyer, because cash buyers really only need, they'll do an inspection and they'll do title. So as long as the appraisal comes in, then we're good to go, So it's really cool.
That's really cool.
Yeah.
Do a lot of companies do that, or just?
Not many at all that I know of. We like to do that. In most cases, I've been doing it so long, I know when somebody is pre-approved, especially if they're a wage earner or something like that. If the file's complicated, with a lot of tax returns and business returns and things like that, sometimes we try to get that in the underwriting
Does that shorten their length of their close?
Yes. So we can, if we get them cleared and get them a loan commitment and probably them go into contract, we can close in as little as 2 weeks. So when you're negotiating that deal,
that's an up. Like, look, we're ready to go. We could close in 2 weeks if you want to.
Right. So like you as an agent, you're negotiating a deal, right? And there's multiple offers on it, and the seller sees I've got a loan commitment, I can close in 2 weeks, and I've got a loan pre-approval and close in 30 to 45 days, pre-qualification closing in 60 days, and your prices, and they're all the same price. What's the seller's going to take our deal 100% of the time, right? Mm-hmm. Even if you offered a little bit less, they still may say, you know what, I know this person's good. They're done. We can close in 2 weeks. I feel much better about that deal, even if it's $5 or $10 grand lower, just because they want to close, and not have any issues with it. So we're able to negotiate better deals in some cases because of that process we have.
I love that.
Yeah.
Let's transition to the market a little bit.
Yeah.
It's been crazy. I know you brought some papers here.
Yeah. So I prepared. I did a real estate report card for Palm Beach County as of today. Our median home price is $360,830, about $198 square foot median home price average.
We're at the end of July 2020.
Right.
So we're we hope we're not sure if we're coming out of COVID or not. Right. We're still every day in the news, like 4 million this,
spike,
3 million.
Right.
Yeah, So, but I feel like the housing market I didn't expect this out of the house. Like, you just don't know what to expect.
Right.
And what are your general thoughts about COVID and how it's affected the housing market in general?
So I think for us here in South Florida, I think our housing market is strengthened by this COVID, because a lot of people, that were living in condos and in places where they were shut down and, couldn't move or couldn't leave their place for many, many months and cooped up, and they just want to get out and come to where, there's water, there's beach, there's, there's more space. So I think our market itself is thriving through this. And I don't know if that's going to be more of a norm going on for many, many years. But even though our market over the last 5 years, the appreciation in our market itself has been about 27% appreciation in your home. So that's fantastic. It's averaging almost 6% a year.
I mean, I feel like we've seen in my condo, I've probably seen more than that. We've owned for 2 years. We bought it. We live here in Chasewood, and we bought at 140, and there's a couple of condos that are similar to ours that are under contract right now. I don't know what it's gonna go for, but they listed it at like 199.
Okay.
So it'll probably be between 190 and 199 when it closes.
Right.
So I mean that's huge. Just that. Right. And is that, since I don't know it very well, you said, is that kind of every 5 years all the time, or is that?
Well, so historically over the last 60 years, it's been an average appreciation of 4.51%.
Okay, that accounts for the lows and the highs.
Right. And so think about this. So you're a homeowner and you're just thinking about, should I buy today or not buy today, right? And interest rates are low, all-time lows. Prices are kind of moving higher. So if you go back 5 years from now, or just think about it 5 years from today, and the median home price is $360, well, guess what? You would gain almost $100,000 of equity, right? So, and just being in your house for over a 5 year period of time, that's a lot of money. If you think about that, that's I wouldn't say free money because you're owning the home, but that is, gives you ability to grow your wealth. So the sooner you get in that home, the better off you are, and not waiting, because we don't know what tomorrow is going to bring.
Right, and this is the past 5 years. Obviously, that changes depending on
what's happening.
What's happening, right?
Yeah.
From a seller's perspective, looking at the market, what do you see? Is it a good time to sell? Is it, obviously, if you sell, like, where do you go? Because the inventory is so low.
So that's the challenge, right? So we're in very, very low inventory environment right now. I've got a couple hundred pre-approved buyers looking for homes that we're talking to and working with and trying to find them something. It's like looking for a needle in a haystack in some cases. So as a seller, depending on what your motivation is, it's a fantastic market for you because there's so many people looking. So if you've got a good home, what I would suggest a seller to do in this market is, let's say they've owned a home for a long period of time. Let's give it a 5 year window, right? Most homes after 5 years need to do some upgrades to them, right? Some people are like, I don't want to do that. I'm just going to sell. So you have two possibilities there. You could say, okay, I'll just sell today. Let somebody else deal with it, right? And take a lower price. Or you maybe put $20,000 into the house and maybe get $50,000 more. So now you've made an extra 30 grand.
Yeah, because because it's a seller's market, I feel like people still aren't settling for less.
Right.
They still want a fair price. They're not going to overpay for something.
That's the truth. In most cases, people, they're looking for a deal, but a lot of times right now, first-time home buyers, they don't want to buy. They don't want to buy that house that needs $20,000 of improvements, right? Because they don't have the money to do it. So they would rather pay a little bit more because you're financing it, right? So that same house, let's just say $100,000 house that the person lived in for 5 years and they're leaving and needs $20,000 of upgrade. Well, the first-time home buyer would rather pay $150 for that turnkey than $100 and try to find $20,000 to make it work, right? So it's a win-win for everybody.
Yeah, because I'm thinking of one of my buyers right now, and he has, I wouldn't say a wide range of a budget, but he's got, whatever he's approved for, I think he's willing to go up to that top number.
Okay.
But he wants to walk in, he's got 2 or 3 kids. He doesn't want to be in a renovated, he doesn't want to be in renovations for the next year.
Right.
We bought our condo, and we literally lived in renovations for 6 to 9 months because we were on cement floors for 2 months because of, for whatever reason.
Right.
And we'll never do it again.
Right.
So we don't mind minor upgrades.
Right.
But if we're having to tear out floors and do a big giant paint job,
sure.
we're not right now, when things are so crazy, like we just need to move in. It's stressful enough.
And
to
it's
move
hard
in.
right now to find people to do work. You know, everyone is so busy because everyone is sitting in their homes for 3 months, looking around, going, "We need to fix this. We need to fix that." So
And they're
right
not
now,
doing it.
well, some people
At
are. I
first.
mean,
Well, at first, like when COVID
right.
hit,
They
all
were
the
just
clubhouses shut down,
right.
everything shut down. You couldn't get in.
Right.
And now all these, all the general contractors, they probably don't have time to do
anything. I mean, if you're lucky to find somebody to do work on your house, a lot of people are trying to do it themselves. So, and they're making choices of, do I stay, fix it up, or do I just move and go to someone else's house that's fixed
and then
it up?
where do you move?
Right. Where do you move? Right.
So
it's tough. There's got to be some motivation there, of where you're going to go, and that's always the biggest thing is, what's your next move? If you get out of where you're at, you got to take consideration the taxes, all the stuff that it takes to move. But, so that's really that comes up a lot, so that's why the first time home buyer market right now, there's so many people looking because there's so many people not knowing where they're going to go next as a move up buyer. And obviously, if you have kids and stuff, the motivation there is you need more room, right? So that's usually in most cases the motivation for a young family, and then other cases are older people looking to downsize, that their family's gone. So those are the two big movements in the marketplace for move up and move down buyers, and that first time home buyer. Those are the opportunities they're getting,
Obviously, there's been a big push. Single-family homes are probably the hardest to find right now. There's been a big push that way. But what do you see in the condo and townhome market? Is that still going?
There's a drastic difference between a townhome and a condo. Okay, people don't really understand that.
I know there is. I just don't know what they all are.
So, and sometimes it's not the information online. From listing agents and the way they list these homes, it's not always clear. I always direct people, and we always look to the county records of how that home is categorized, if it's categorized as a townhome or a condo. A townhome is treated as if it was a single-family home, and it's governed by an HOA, a homeowners association. Mm-hmm. So those are similar in itself. A condo is a completely different animal because a condo is governed by a condo association, and they follow completely different guidelines. So a condominium for a first-time home buyer requires a full project approval, which means that they have to abide by, we have to get 2 years worth of budgets. So they have to show a minimum of 10% reserves of their budget that they hold in reserves to qualify. That's one thing. They can't have any litigation. Well, if they do have litigation, some are allowed, but most aren't, depending on what that litigation is.
I had, just to butt in there, that's one reason it was hard for me to get approved in the one I was in because there was litigation. There was a lawsuit against someone who got hurt at the pool or whatever. And I literally talked to, I think, 3 lenders. And the third lender I talked to says, "Oh, I just got someone approved in there." So they'd already gone through the approval process and they were able to close real quick.
Right. So that's one thing that comes up a lot. Right now with this pandemic we're going through, the other challenge is people that aren't paying their condo association dues. So another characteristic of the approval process is you've got to show that there's no more than 15% of the whole community, no more than 60 days past due on their dues, okay? And no more than one entity can't own more than 10% of the project. Now, there's some different guidelines depending on how big the project is. Some smaller ones, I think it's like 15 units or less, have different qualifications, but the normal size, bigger ones, those are the guidelines. And what happens is, and there's 2 sets of approvals. So you have what they call a full project approval, which I just went through. Then you have a limited approval process. So the full project approval allows you to go in there and do a conventional loan at 3%. Now to do an FHA loan in there requires a whole different approval process. So there's an approval process for conventionals for Fannie and Freddie and a whole different one for FHA. VA is a different one for VA as well. So there's 2 different approval processes for the government loans that are done separately, independently of each other, and then the conventional approval process. And if for whatever reason it doesn't qualify for that approval process, the full project approval, then what they do is they go down to a limited review, which only asks limited questions. But the down payment requirements go from a 3% minimum to a 25% down payment requirement for primary residences and a 30% down payment requirement for a second home residence. So it's a significant difference. And there's so many condos in South Florida. I spent most of the 2000s. I worked for a company at the time where we converted most of downtown West Palm Beach. I'm familiar with all the big projects down there because I converted a lot of them from apartments to condos. It was a big move in the early 2000s. And I did, thousands and thousands of units. There were times where, there were days where we would, they would start selling these units on a Friday, and by Sunday they were completely sold out of 300 units. And the price would change every hour. So you were in line standing around the block, and by the time you get up there, it may have gone up 50 grand. And that's how they were doing it back then. And then we would do closings. We had closings. We would close at a Marriott hotel in a ballroom, and there would be, 50 rows of closing tables, and people just signing closing documents. We would close hundreds at a time.
That's insane.
It was insane. It was truly crazy. But we converted a lot of the condos back then that way. And it was an interesting time. So I really understand the condo market a lot. And I try to educate listing agents when they get a condo listing to gather all the documentation, the budgets, understand your product. Because the biggest challenge for us as lenders and for buying agents is your client gets in there and they want to go 5% down. Listing agent has no idea if the project is approvable or not, and they're not on the approved list, so you have to go through the approval process. So we have to get all that stuff I just talked about. You have to analyze it, get it submitted, and you've really got to get that done within a 15-day inspection period. And that sometimes isn't enough time.
And if you don't have all your stuff lined up,
then it doesn't qualify. Then you still have the loan after the inspection period. Still have the loan part of it that they can still kind of be turned down for the project. But ideally, if you're a really good listing agent, understand your product on a condo, you would get all that information up front. So when that buyer goes into contract, or before, because it's a waste of time for everybody, right? Before that buyer goes into that deal, you have the documentation to say, listen, this project is approvable for the 3% or 5% down, so we can go. But if you go into the project and the agent goes, listen, I know this project can't be approved for whatever reason, it doesn't qualify, that buyer will be told you have to put down 25 or 30% if you're financing it. So that may just eliminate, some of those buyers in the marketplace, but also saves everyone a lot of time because it does take time to evaluate all that information. So I always try to educate the listing agents on gathering that information. And the problem is a lot of the associations, have farm out their stuff to these other entities. And there's a lot of turnover and a lot of people don't keep up with it. So there's a lot of expired condominiums on the books. I mean, I went back to a lot of the places that I converted over the years, and there's been so much turnover. But I've reapproved a bunch of condos downtown West Palm Beach recently with some of the ones that have expired because we have some buyers in there. So we were able to go in and reapprove them and work with the associations to do that. So it's definitely a totally different animal. And in most cases, a lot of the banks and online lenders have no idea what they're doing in regard to that. I had a client call me up yesterday, matter of fact, and he was putting an offer in an $800,000 condominium. And I was trying to explain to him all of this, and he said, I don't know what you're talking about. I've talked to 5 other different lenders. They never mentioned this once, that I have to go through this process and that there's a possibility I may have to put 30% down because he's buying as a second home. If it doesn't get qualified, I go, well, then that should be a red flag to you that you're talking with people that don't understand the product that you're buying. So we it seems like a lot, but if you don't do what you have to do up front, there's going to be problems in the end.
So your message to like someone like me, a new agent, if someone's ever interested in a condo, just to get all the information up front before we even.
You need to get it up front. And the problem is, in some cases, or in most cases, which there's some class action lawsuits about this. That's a whole different story. But the condo associations charge get that information. For a condo questionnaire to be filled out, sometimes they charge $300 to $500. So you as a buyer, you're spending an inspection $500, a condo questionnaire $300 to $500, an appraisal $500. So you're $1,500 into the deal before you even know if it's approvable, right? So it's not a. It happens so frequently. I get so frustrated with it because the seller can gather all that information up front, and the listing agent should really have that readily available so they know what kind of product they're selling, because it'll save so much money and time for that buyer and the seller and everybody. It's just if they did all their all the work and they put it all together up front.
Makes sense. So. Well, to wrap things up, tell me what you're thinking about in the next 3 to 6 months, where the market's going. What do you see?
So I see we are our environment will continue where it's at. I think there's the problem we have is low inventory, so that's going to keep our market strong. Interest rates will stay low through the end of this year and even going into next year. So I think we're in a unique place in the situation where we are, that we're going to see we're going to be in a market that is going to be on fire. There's going to be so much opportunity for potential buyers to get in, as long as we can provide the inventory for them. So I think we're going to be in a strong market, and I don't think there's anything out there that's proving or signaling that we're not. And even going into next year, I think it will be the same. I think the only challenge that we're going to see going into next year is accounting for the 5 million people that are currently in forbearance. And if they haven't, yeah,
is that nationwide?
Yeah,
it's a lot.
That's a lot of people. So if those people can't catch up on their payments, can't modify their loan, they're going to start foreclosures proceedings. I think it's maybe after the first quarter of next year on those people.
So like April, May.
Yeah, and then there's going to be a log of of those filings in the county and things like that. So I don't know how that's going to play, but it's going to play in some way, shape, or fashion. It just has to, because most of the people that were in a forbearance situation and really put themselves in it for need basis, they didn't have the money, and they probably still don't, and they probably don't have a job to go back to. A lot of people in the service industry, right? It's a lot of those places will not look the same as they did in the past, and the amount of money people were making in that industry may not ever be the same. And
got half as many tables, half as many tips, half as many
people working. So if you run a restaurant and you had 10 servers and stuff, now maybe you only need 3. Where are those other 7 people going to go? And if every restaurant's like that, there's going to be a lot of that going on as well. So, and it's a challenging environment for the self-employed, service-related person right now, depending on what your business is. So that's the only challenge I see is that type of a business that you're in, if you've thrived through this, or have you been affected by it. So if you've been affected by it, your world looks totally different than somebody that has kind of thrived through it.
So you see, in terms of the housing market, you see a little bit of the same for the next 6 months or so.
I do. And I think it'll be driven a lot by the people that want to come here. Because think about this too. So when they changed all the tax laws, in states that have state taxes, those people were looking to get out of there anyway. Some like California or New York and stuff, where there's heavy.
And this is just pushing them.
So there was, this catapulted their decision. So if you're making greater than $250,000 a year, you're getting clipped pretty heavily on state taxes in the state tax states, and you almost get a pay raise. And since most of the people are working from home anyway right now, so guess what?
Might as well do it.
Might as well do it. Right. Might as well go into a state where there's no state tax. Buy a house, and have some space and work out of your home. So.
On the water,
or whatever. And get a pay raise doing the same, doing
Yeah.
it. So if you're in a job that that allows that, and you've thrived through this, then why not be somewhere tropical, and out of the city and out of a condo that you've been stuck in. That must drive people crazy. I can't even imagine. But
can't tell you how with a 2-year-old, like even down here in a condo is not not always fun. Last question, how do you think, I haven't been around enough elections and old enough to understand how that affects things, but how do you see the political landscape sort of affect, or does it?
So if the current administration stays into place, I think we'll continue in this pattern of where we are.
But still seeing a correction.
I don't know. I mean, if you're talking specifically about the housing market itself, I think we stay strong for many years. If the administration changes, I think there's going to be major impacts on certain things. I don't know how. Think of us, we're kind of in a bubble in a sense in South Florida. I don't know if we'll be affected by the political changes as much as some other places may be. But so I don't see us being affected from the housing standpoint. I think that our challenge here in South Florida may be just the jobs and the
service related jobs.
Yeah.
And that's going to be an issue no matter who's in office.
Who's in office, right? So.
Right. Well, maybe the current administration will come down here and hire a bunch of people. Maybe he'll lose and open up a new restaurant or golf club.
Something. Yeah, man. So.
That's great. Well, thank you so much, Christian, for coming and chatting with me. I've learned so much, and I appreciate it. So thank you.
I appreciate your time and the opportunity to be on the show and chat about it. So I look forward to next time.